What if everything you've been told about reducing risk with age is wrong? Stay until the end, because this research shows which portfolio survives retirement better than bonds. And the answer makes most advisors uncomfortable. A new 2025 research paper shocked the investing world by saying something almost nobody expects. The optimal long-term portfolio may be 100% stocks for your entire life, even through retirement. No glide paths, no heavy bonds later, just globally diversified equity held long-term. This idea triggered heavy criticism, but the data behind it is serious, deep, and worth understanding before you dismiss it. This research does not rely on simple assumptions or recent market history. It analyzes stock, bond, and bill returns across 39 developed countries, with data going back to 1890. That creates more than 2,600 years of combined market history, instead of guessing the future. It simulates millions of possible lifetimes using real historical patterns, capturing how markets actually behave over long periods. The key method used is called block bootstrap. Instead of assuming returns are random and smooth, it stitches together real historical chunks of market data, usually 10 years at a time. This preserves crashes, recoveries, volatility clustering, and long drawdowns, in simple terms. It creates realistic life paths for investors instead of fantasy models that ignore how brutal markets can actually be. The result is uncomfortable when success is measured by sustainable retirement spending and lower failure risk. A globally diversified 100% equity portfolio consistently outperforms traditional portfolios that shift into bonds over time. This holds true not only for average returns, but also for worst-case outcomes, directly challenging the belief that bonds automatically make retirement safer over long horizons. To put it in perspective, the study compares how much you would need to save to reach the same retirement outcome. A classic 60-40 stock-bond portfolio would require saving almost doubled income compared to the 100% equity strategy. Even small bond allocations meaningfully reduce long-term efficiency. Bonds feel safer emotionally, but historically they come at a very high opportunity cost. One common objection is that 100% stocks must increase the risk of running out of money in retirement. Surprisingly, the simulations show the opposite, using standard withdrawal rules. The all-equity portfolio had a significantly lower probability of financial ruin than portfolios with large bond allocations. Volatility looks scary, but long-term purchasing power risk turns out to be far more dangerous. The study also tests whether changing allocations based on age improves outcomes. The answer is mostly no, even when investors are allowed to change portfolios every year. The optimal solution remains almost entirely equities at nearly every stage of life. Only a small, temporary cash buffer at retirement appears useful. And even that effect is limited and quickly disappears. What about market valuations? Surely high valuations mean stocks should be reduced. The paper tests this by adjusting portfolios based on price-to-dividend ratios. The impact is surprisingly small, even in extremely high valuation periods. The optimal portfolio only shifts modestly and remains equity-heavy. Market timing provides far less benefit than most investors believe. International diversification turns out to be critical. A globally diversified stock portfolio dramatically improves outcomes compared to concentrating in a single country, even when excluding the United States entirely from the data. The results barely change. This suggests the conclusion is not driven by U.S. exceptionalism, but by the fundamental long-term behavior of equity markets worldwide. Leverage is also tested, and this is where things get nuanced. With high borrowing costs, leverage makes no sense. With very low borrowing costs, limited leverage can improve outcomes. But the popular idea of levering stock and bond portfolios to beat 100% stocks largely breaks down. Over long horizons, theory looks clean, reality does not cooperate. None of this means 100% stocks are easy to hold. The drawdowns are real, deep, and emotionally brutal. The paper makes it clear that behavior matters. Most investors will abandon the strategy at the worst possible time. This creates an uncomfortable truth. The strategy works best for those who can tolerate volatility without reacting, which is rare. The real takeaway is not blindly going all in on stocks. It is understanding that time horizon matters more than comfort, and that traditional advice may overestimate the safety of bonds. If you invest through low-cost global equity ETFs, stay disciplined, and think in decades. Volatility becomes noise. If this helped, subscribe. This channel focuses on data, not comforting stories.